Welcome to this briefing on state-sponsored speculation, Bitcoin reserves, and the US dollar. A handful of US states are now experimenting with using public funds to invest in Bitcoin. While this is framed as innovation, it signals a dramatic shift, the blending of public finance with speculative crypto markets. The implications for state stability, institutional trust, and even national monetary cohesion are significant and underexplored. Three states, Texas, New Hampshire, and Arizona, have either passed or proposed laws to create strategic Bitcoin reserves. These policies may seem like small scale innovation, but they carry outsized risks, including state credit exposure to extreme volatility, weakened federal monetary cohesion, and ideological capture of fiscal policy. While marketed as modernization, this is high risk speculation with public money, often without robust oversight or democratic input. A strategic Bitcoin reserve is a mechanism by which a state holds Bitcoin either by directly purchasing it, setting up a fund to do so, or retaining seized assets like those from law enforcement. Supporters claim it protects against inflation or federal overreach. But this is not a neutral hedge. It's a deliberate positioning of the state within a parallel financial system. The purpose isn't just investment, it's political. These reserves are generally controlled by officials like state comptrollers or treasurers, often under new legislation that grants them broad authority. In some cases, small advisory committees are created. Crucially, the funds are often separated from the general treasury, meaning they may not be subject to the same public scrutiny. This structure can obscure risk, evade standard oversight, and centralize control in political appointees. State investments have traditionally focused on safety, liquidity, and long-term stability. Think municipal bonds or cash reserves. Bitcoin, by contrast, is inherently volatile, lacks institutional backing, and is susceptible to manipulation and market shocks. This shift from stewardship to speculation risks undermining state fiscal credibility and could impact everything from pension obligations to bond ratings. The stakes are far higher than they appear. This map shows just how rapidly state-level crypto experimentation is expanding. While only a few states like Texas, New Hampshire, and soon possibly Arizona have fully enacted legislation to create Bitcoin reserves, at least 17 states have introduced related bills. Some aim to directly invest public funds, others to retain forfeited assets or encourage mining. Many of these initiatives are backed by ideological think tanks like the Satoshi Action Fund and ALEC, which have flooded legislatures with model bills. Though most proposals haven't passed, the sheer volume and speed of this activity signals a coordinated national push to reorient state finances toward cryptocurrency and away from federal monetary norms. New Hampshire was the first state to formally pursue a Bitcoin reserve strategy. Backed by Free State libertarians and advised by the Satoshi Action Fund, the state passed legislation directing its treasurer to consider holding cryptocurrency. Supporters claimed it was about sound money and innovation. But critics argue it's a radical ideological experiment with public funds, exposing the state to market volatility while bypassing traditional financial safeguards. Arizona's path to a Bitcoin reserve has been more gradual. While the state hasn't gone as far as New Hampshire, it has passed laws allowing retention of forfeited crypto assets and floated proposals to recognize Bitcoin as legal tender. State Treasurer Kimberly Yee has pitched it as a way to hedge against inflation, but so far, Arizona has stopped short of a full reserve strategy. The careful pace reflects internal divisions and concerns about volatility and federal backlash. In North Carolina, lawmakers introduced a bill to study holding digital assets in the state pension fund, a significant escalation. Though framed as a pilot program, the language closely mirrors model legislation pushed by ALEC. Critics warn it opens the door to injecting crypto speculation into retiree benefits, without the protections or oversight typical of public investments. With little public scrutiny, North Carolina is quietly advancing one of the most high-stakes crypto strategies yet. By mid-2025, at least 17 states have introduced or passed laws related to state-held crypto reserves. This map shows how the trend is spreading. A handful of states, including Texas, New Hampshire, and Arizona, have enacted laws. Others are considering or debating bills, many lifted directly from ALEC templates or influenced by the Satoshi Action Fund. What looks like financial modernization is often a coordinated ideological push, redefining public finance under the guise of innovation. while putting taxpayer funds at unprecedented risk. The decision to allocate public funds to Bitcoin exposes states to an unprecedented level of economic risk. This isn't just about market fluctuation. It's about the structural instability of an asset whose value is driven more by internet hype and political headlines than real economic fundamentals. Bitcoin's extreme volatility, coupled with its opaque and poorly regulated market, threatens the solvency of pension funds, the integrity of state budgets, and the financial future of everyday taxpayers. These aren't abstract concerns. Credit downgrades, budget shortfalls, and taxpayer funded lawsuits are real consequences states could soon face. In short, this isn't a hedge, it's a fiscal time bomb. Bitcoin isn't just volatile, it's radically unstable. According to Fidelity, it's 3 to 4 times more volatile than major equity markets. A single crash can wipe out 50% of a state's investment overnight with zero safety net. And the risk doesn't stop at price swings. Each Bitcoin transaction consumes over 1,400 kilowatt hours of electricity, enough to power an American home for nearly 50 days, draining public infrastructure while enriching speculators. When states gamble on Bitcoin, they're not just risking money, they're risking fiscal stability, environmental sustainability, and public trust. When states invest public funds in Bitcoin, they're not just betting on a volatile asset, they're gambling with essential services. In Texas, for example, SB 21 would fund the Bitcoin reserve directly from legislative appropriations. Any losses hit the budget like a wrecking ball, forcing tax hikes or service cuts. Pension systems aren't insulated either. S&P Global warns that crypto volatility could trigger massive unfunded liabilities, requiring taxpayers to bail out the difference. And when disasters strike, locked up crypto funds mean fewer resources for emergency response. This is more than a risky investment. It's a structural threat to fiscal resilience and public safety. When states gamble on crypto, credit agencies are watching and issuing warnings. S&P Global and Moody's both flag the risks: crypto volatility, cyber threats, and fiscal instability. If these holdings grow, so do the consequences. A downgrade isn't just a warning label, it's a costly penalty. It forces states to pay more to borrow money, draining budgets that should be building schools, repairing roads, or funding healthcare. This is the hidden cost of crypto speculation: higher debt, weaker infrastructure, and long-term financial damage that the public ultimately pays for. This is the nightmare scenario, what economists call a doom loop. First, the state's Bitcoin reserve crashes, wiping out value and triggering a budget crisis. Emergency funds vanish, essential services get slashed. Credit rating agencies respond, downgrading the state's standing, which instantly hikes the cost of borrowing. That compounds the deficit, deepens the crisis, and starts the next loop. Trust in government collapses, political instability rises, and recovery becomes harder with every turn. This isn't theoretical. It's the predictable outcome of gambling public funds on a volatile asset with no safety net. Not all state-level Bitcoin reserve bills carry the same risk, but the threat is real across the board. Texas's model is the most aggressive, directly spending public dollars on crypto with almost no guardrails and a glaring corruption risk through opaque donation channels. Arizona takes a more limited approach, using forfeited assets, but still faces reputational and governance challenges. And New Hampshire. It proposes investing up to 5% of all public funds, an enormous exposure that carries high fiscal and political risk, even without a donation channel. What connects them all is a dangerous gamble with public money, underwritten by taxpayers. The movement to create state-level Bitcoin reserves isn't about financial innovation. It's an ideological rebellion. Fueled by libertarian ideals and anti-federal sentiment, these reserves signal a deeper intent to weaken trust in central institutions and pave the way for radical political and monetary exit. It's not just an asset strategy. It's a declaration of defiance, aiming to decentralize power not just from Wall Street, but from Washington itself. Bitcoin didn't emerge in a vacuum. From the start, it was championed by early adopters drawn to its anti-government ethos, a digital escape hatch from centralized control. That techno-anarchist vision gave rise to a broader anti-Fed narrative, framing Bitcoin as a hedge against fiat debasement by institutions like the Federal Reserve. Think tanks like the Cato Institute and Heritage Foundation amplified this message, arguing that private currencies serve as a check on government overreach. This isn't just economics, it's ideology, cloaked in code. The push for Bitcoin reserves at the state level isn't just a monetary experiment, it's a political maneuver. By adopting an asset outside federal control, these states are signaling a form of financial independence that aligns with sovereign state rhetoric. While few openly advocate secession, the implications are clear. This is a step toward financial decoupling from Washington. If scaled, it creates a parallel economy that erodes the dominance of the US dollar and the authority of the Federal Reserve. This isn't fiscal policy, it's a blueprint for soft secession. Bitcoin's appeal has expanded far beyond its libertarian origins. It now intersects with some of the most dangerous ideological forces on the far right: Christian nationalism, populist grievance, and anti government extremism. Academic research shows a clear link between interest in cryptocurrency and conservative moral foundations. It's also been adopted early by white supremacist groups, not just for ideology, but for infrastructure, to evade scrutiny, raise funds, and undermine the legitimacy of traditional financial institutions. In these circles, Bitcoin isn't just a currency, it's a symbol of rebellion against a world they believe has betrayed them. This movement didn't rise from grassroots demand. It was built from the top down by crypto billionaires, venture capitalists, and political operatives. In the 2024 cycle, crypto companies poured $274 million into elections, making up nearly half of all corporate political contributions. Just three super PACs, Fairshake, Protect Progress, and Defend American Jobs, spent over $133 million pushing crypto-aligned policies. Their investment paid off. 85% of candidates backed by these PACs won their races. This is not organic policymaking. It's billionaire capture of our democracy, executed through cold, hard cash. Let's name names. Coinbase has spent over $50 million on PACs. $45.5 million of that went directly to Fairshake PAC. They also provided expert testimony backing Arizona's crypto legislation. Ripple followed suit with nearly $49 million in PAC spending, another $45 million to Fairshake alone. And then there's the Satoshi Action Fund, a nonprofit pushing state-level Bitcoin bills. They helped craft New Hampshire's HB 302 and are now replicating that blueprint nationwide. This isn't just spending, it's a strategic assault on democratic policymaking, funded by a small circle of crypto giants. Meet the ideologues shaping crypto policy from the shadows. Peter Thiel, co-founder of PayPal and Palantir, has called democracy incompatible with freedom and bankrolled Trump and J.D. Vance. Balaji Srinivasan, former Coinbase CTO, dreams of network states, online crypto communities that buy land, amass wealth, and claim sovereignty. These aren't fringe ideas, they're blueprints. And when tested in the real world, they failed. Miami Coin collapsed into worthlessness. Nevada's blockchain city evaporated after a water rights disaster. Wyoming bent over backwards to deregulate and still came up short. Ideology over reality, funded by billionaires with delusions of sovereignty. This isn't just a financial movement, it's a full-scale influence campaign. Coordinated messaging pushes crypto talking points across media, podcasts, YouTube, and X, using emotionally charged language to bypass critical scrutiny. They frame crypto as freedom, innovation, and even digital gold. But these are misleading analogies. Bitcoin's volatility rivals penny stocks, yet it's falsely branded as safer than the dollar. Why? Because elite interests stand to gain. A small, ultra-wealthy group is using their financial power to hijack public policy for personal profit. This is elite capture disguised as populism, and the rest of us are left holding the bag. While state-level crypto pushes are happening from the bottom up, Trump is driving a top-down revolution. His administration isn't just cheerleading crypto, it's trying to embed it into federal law. The Genius Act, passed with bipartisan support in the Senate, if passed, will create a regulatory framework for stablecoins. But this isn't just policy, it's personal. Trump has financial stakes in the crypto industry and allies who stand to profit. When the same man promoting a currency is also shaping the rules that govern it, that's not leadership, it's structural corruption. The merger of personal gain with public power is a direct threat to financial stability and democratic accountability. The Genius Act sounds responsible on the surface, requiring one-to-one reserves and allowing regulation by either federal or certified state agencies. But dig deeper, and the dangers are clear. There are no meaningful guardrails to prevent conflicts of interest, especially with Trump's personal holdings in crypto ventures like Trump Coin. Worse still, the bill gives stablecoin holders priority in bankruptcies, paving the way for taxpayer funded bailouts if the system crashes. This isn't just regulation, it's a power grab wrapped in legitimacy, engineered to protect insiders and offload risk onto the public. Trump's crypto dealings aren't just business, they're a sprawling, unregulated empire of potential corruption. World Liberty Financial, co founded with his sons, pulled in over $550 million. Then came the Trump meme coin, a speculative circus that raked in $350 million, its value skyrocketing when linked to exclusive perks like dinner with the president. Add in foreign money, like a $2 billion investment funneled through Trump linked coins by UAE backed entities, and the red flags aren't just ethical, they're constitutional. This isn't entrepreneurship, it's influence peddling on a global scale, backed by federal policy and unchecked power. At the heart of public trust is the fiduciary duty, an obligation for state officials managing public funds to act with care, loyalty, and prudence. The Uniform Prudent Investor Act enshrines this, demanding decisions be made within the context of a sound, diversified investment strategy. But Texas SB 21 undermines that standard. By invoking the language of the prudent investor, it creates a legal smokescreen, appearing responsible while authorizing risky, speculative bets with minimal oversight. This isn't fiduciary care, it's fiduciary theater. And behind that curtain, a dangerous breach of the public's trust. Texas SB 21 opens a Pandora's box of corruption risks. It permits opaque voluntary crypto donations with minimal safeguards, practically inviting money laundering behind a paper-thin veil of domicile verification. At the same time, state-held crypto wallets holding hundreds of millions become juicy targets for cyber attacks. One breach and the funds are gone forever. Even worse, the law empowers fund managers to make high-risk complex bets, staking, lending, derivatives, with little oversight. This isn't just financial recklessness, it's a blueprint for insider dealing and institutionalized fraud. When accountability disappears, corruption rushes in. Can taxpayers stop this in court? At the federal level, it's nearly impossible. Courts have long held that taxpayer standing is too vague. Unless spending violates a specific constitutional clause, like the Establishment Clause. Complaints about misused tax dollars usually get tossed, but at the state level, it's a different story. Many states do allow taxpayer lawsuits to block unlawful public spending. If a state constitution includes a prudent investor clause, plaintiffs could argue that gambling public funds on crypto violates that duty. Success would hinge on how the state's laws and courts interpret that fiduciary responsibility. When states like Texas move to adopt crypto as public infrastructure, they aren't just playing with market risk, they're creating new national security vulnerabilities. Decentralized, deregulated systems are catnip for money launderers, terror financiers, and hostile governments. Cryptocurrency's pseudonymity and lack of centralized oversight make it ideal for covert financial operations, and it's already happening. North Korea's Lazarus Group has stolen billions through crypto heists to bankroll weapons programs. If states run their own wallets, those become high-value bullseyes for foreign hackers. This isn't abstract, it's a known threat, and state lawmakers are opening the door wide. State-level crypto systems aren't just financial experiments, they're national security vulnerabilities in the making. First, sanctioned states and individuals can exploit regulatory gaps to bypass federal sanctions. These fragmented systems become soft entry points into the broader U.S. financial infrastructure. Second, nearly all Bitcoin mining hardware is manufactured by Chinese companies. That means backdoors or firmware exploits could be embedded at the source, giving adversaries a hidden hand in critical financial infrastructure. And third, those same vulnerabilities could be used to disrupt mining operations, block transactions, or even target the U.S. power grid, especially since mining is deeply intertwined with local energy infrastructure. The risk isn't hypothetical, it's systemic and it's growing. Securing a crypto wallet that holds billions in public funds isn't just a technical challenge, it's a national responsibility. Best practices demand multi-signature wallets, geographically distributed custodians, and airtight protocols. But most state governments simply aren't equipped for that. Laws like New Hampshire's HB 302 sound good on paper, but they rarely come with the resources or expertise needed to do it right. This creates a national security nightmare. Every state that builds its own crypto treasury becomes a potential weak link. A hacker doesn't need to breach the Pentagon. They just need to compromise the one state with the weakest cybersecurity or the most corrupt official. In cybersecurity, the system is only as strong as its most vulnerable point. And right now, that point might be a state run crypto wallet. Let's be clear, state level adoption of Bitcoin isn't just a policy experiment, it's a direct collision with the US Constitution and the Federal Reserve's mandate. Article 1, Section 8 gives Congress, not state legislatures, the exclusive power to coin money and regulate its value. The Federal Reserve acts on that authority to manage inflation, employment, and economic stability. When a state diverts its treasury into Bitcoin, it's not just investing, it's sending a message, a vote of no confidence in the US dollar, in the Fed, in national monetary policy. And if this trend spreads, we face a fractured financial system, states operating under different monetary logics, with different rules, different risks. That fragmentation would inject chaos, confusion, and transaction costs into everything from federal aid to commercial contracts. This isn't just poor governance, it's financial secession, one Bitcoin reserve at a time. So, what happens when state crypto policy collides with federal authority? The legal answer lies in preemption, a principle embedded in the supremacy clause of the US Constitution. When federal and state laws conflict, federal law wins. Full stop. If a state establishes Bitcoin reserves as part of its treasury strategy, the federal government could challenge that move as an unconstitutional interference in monetary policy, an area the Constitution delegates exclusively to Congress and the Federal Reserve. There's precedent. The Office of the Comptroller of the Currency has long argued that federal authority must override state laws that threaten the uniformity of our national banking system. But here's the twist. States won't say they're creating a new currency. They'll argue they're just managing their investments, like any prudent steward of public funds. The legal battleground won't be about Bitcoin itself. It'll be about who has the final say over the future of money in America. The push for state-level Bitcoin adoption isn't bold. It's recklessly familiar. We've seen this movie before. High-risk, ideology-first economic experiments that end in disaster. Kansas, 2012 to 2017. Governor Brownback's real-life experiment in slashing taxes to unleash growth. It tanked the economy. Revenues collapsed, services were gutted, and even Republicans were forced to reverse course. A cautionary tale of ideology over evidence. The 2008 financial crisis. Wall Street sold complex, unregulated financial instruments as revolutionary. They were anything but. Hidden risks detonated the global economy. Bitcoin boosters are making eerily similar promises: opaque tech, no regulation, and massive exposure. And Argentina, in 2001, pegging their currency to the US dollar, gave them zero flexibility. One shock and the entire system collapsed. States adopting Bitcoin are doing something just as dangerous, tethering their future to a volatile asset they can't control. These aren't isolated stories, they're warnings, and we're ignoring them again. This isn't just a fiscal gamble, it's a democratic time bomb. State-level Bitcoin adoption threatens more than budget stability. It risks shattering public trust in democratic institutions. The bond between citizens and government is already frayed. A high-stakes crypto loss could snap it entirely. Imagine the fallout. Teachers, firefighters, and public workers watch their retirement savings vanish overnight in a Bitcoin crash. Headlines scream lost public funds. The outrage would be immediate and justified. What follows? Populist fury, anti-government narratives, a surge in extremism, and a devastating blow to the legitimacy of state governance. This isn't theoretical, it's foreseeable and preventable. Bitcoin's environmental cost isn't theoretical, it's catastrophic. Each Bitcoin transaction burns through over 1,450 kilowatt hours, more electricity than an average US household uses in 7 weeks. That's not a currency, that's a carbon bomb. In Texas towns like Granbury, residents endure the constant 100 decibel roar of mining rigs and cooling fans, 24 hours a day. It's not just noise pollution, it's a public health crisis masquerading as innovation. And it's accelerating. By 2030, Texas energy regulators say crypto mining could consume as much electricity as the entire city of Houston. Let that sink in. Bitcoin isn't just speculative, it's extractive, and the bill is coming due in decibels, dollars, and degrees. This isn't about financial innovation, it's about policy capture. Strategic Bitcoin reserves are not neutral tools. They are the product of a coordinated ideological campaign designed to hijack public institutions and rewire state authority to serve private interests. They introduce multiple risk vectors: threats to public finances, invitations to corruption and illicit finance, the weakening of federal monetary authority, and a slow erosion of trust in democratic governance itself. And all of it is cloaked in a deceptive narrative. Buzzwords like innovation and freedom, masking a high risk, high consequence project with real world fallout for taxpayers, pensioners, and the very foundation of democratic stability. This isn't just reckless, it's strategic, calculated, and dangerously effective. We're not powerless, but it will take coordinated action at every level of society to respond to this threat. At the federal level, the Treasury and Federal Reserve must issue joint guidance on systemic risks. Congress needs to reassert constitutional authority over national monetary policy through hearings, legislation, and oversight. National security agencies should conduct formal threat assessments of state held cryptocurrency reserves. At the state level, legislatures must impose an immediate moratorium on public fund allocations for crypto. Fiduciary laws must be strengthened, existing reserves must be audited with radical transparency, and campaign finance loopholes must be closed to curb undue influence. And on the civic and legal front, public interest law firms should challenge the legality of these reserve laws. Investigative journalism must expose financial ties between lawmakers and the crypto industry. Civic organizations must educate the public on the critical difference between prudent investment and reckless speculation, masquerading as innovation. This isn't just a financial debate, it's a democratic defense strategy. We've seen how a manufactured financial scheme is being passed off as innovation, how it threatens our institutions, undermines democratic oversight, and benefits a narrow, unaccountable elite. But this isn't just about cryptocurrency. This is about what kind of economy we build and who it's built for. We need public infrastructure and financial systems that prioritize stability, equity, and service, not volatility, secrecy, and profit for the few. This fight demands action now from Congress, from state lawmakers, and from the civic institutions that hold power accountable. We need real transparency, real safeguards, and real investment in the common good. Because we don't need more crypto billionaires. We need a financial system that earns and deserves public trust. This is the fight for the public future, and we must not sit it out.